Welcome to the Alternative Investing Club Friday speaker series. Today is November 22nd, 2024. And today we have with Ramz, who's going to be talking to us about self-directing IRAs. And now my YouTube is feeding back on me. So let me start off first with just a couple of announcements here, and then we'll pass it over to Ramez. The first thing is at the beginning of the year, I'm going to be trying to change up how we meet just a little bit, and I'm still in the process of figuring that out. I'm going to move to using, instead of just Zoom, I'm going to add StreamYard to it. And that's going to allow us to go live on LinkedIn, YouTube, Twitter, a couple of other platforms all simultaneously. So I don't know that it's going to change anything for how you guys join Zoom. I think I can get Zoom to stream to StreamYard. But if there's ever any confusion, of course, you can always go to alternativeinvestingclub.com. In fact, let me just bring that up right now and show you. And every Friday, let's see. So every Friday, the section up here changes. Instead of being a section that will ask you if you want to join the mailing list to receive the Friday meeting, it'll actually have the button right here just to link directly to this Zoom call or StreamYard or wherever it happens to be. The weekly email will also change in order to reflect the change, but I just want to make people aware that this Zoom link that we've been using for the past year most likely will be changing. If I can keep it the same, I will, but just a heads up. Second thing to announce, and I do need to send the email announcement out on this as well. Our oil and gas deal is now fully subscribed, and I know there were a number of people that were still on going through the process of reading through the legal documents. We'll put you on the waiting list or the priority list for the next deal, and send that to you. But that particular deal is fully closed. And then third announcement. I received news today, or not today, 2 days ago, that Think Multifamily, one of the groups that we worked with originally at the very beginning of the club when we were doing private placement, Good Samaritan Capital worked with them, I should say. They continue to give bad news, and as a group, they have completely collapsed. And so we do have an investment where we're losing some capital that investors put in. So I just wanted to let people know that 3 deals out of 15 are with Think Multifamily. And it's very unfortunate that in our early days we worked with them. They, as a group, they were well positioned at the time, and they grew too fast. And when interest rates rose, they collapsed. And so I just wanted to put that out there that I'll be following up with everybody involved with that, which isn't too many, thankfully. But having said all that, I will turn it over to Ramez. Ramez, welcome to the group here.
Daniel, thank you so much for having me. Is it okay that I could start presenting? You want to jump right in, or
Yeah,
how do we?
absolutely.
All right, let's do it. So give me 1 second. There's the IRA Club website. Let's just start from the beginning.
By the way, in case anybody's worried, the people that are in that deal know who they are, so don't worry about if you're wondering if that's you or not.
You know what's funny, Daniel, is I was actually writing that down because there's actually a couple IRA Club members that have invested with Think Multifamily. So I actually am happy that you said that. None of them are nothing recently, but I'm happy you said something. So I'm going to have my compliance team take a look at that.
Yeah,
Well, I had no idea, but thank you for letting me know, because that was just a little red flag on my side. But we're here to talk about retirement accounts. I promise, Daniel, I will not make this boring. I will not put you all to sleep. And that's what we're here to talk about, a specific type of strategy that I actually hold near and dear to me, that I educate all over the country. I probably just this year alone did about 40, 45 events talking about harnessing the power of your retirement account, giving you the flexibility and control into what we like to call self-directing, okay? Many of you, by the way, I am huge on QR codes. I use a lot of graphs, a lot of slides, a lot of numbers. If you want to pull out your phone, and I know a lot of people are listening probably on their phones. If you want to scan this QR code, it's going to give you the PowerPoint presentation. So that way you could just follow along with me. Some of the charts regarding numbers and symbols might be a little bit too small to read. So again, just a little bit to help you out and follow along. But IRA Club. About myself, I'm boring. I'm the vice president. There's really not much to say. If anyone wants to schedule a call to talk to me about that, I'm more than happy to do so. But I want to designate as much time as I can to educating. And I always start off, or many people that we meet always start off by asking, who is IRA Club? So many of you that have retirement dollars, IRAs, 401ks, 403bs, in particular employer plans, I'm talking to you specifically because you're the ones I'm trying to educate the most. Think of IRA Club like Fidelity, Vanguard, and Schwab. That's the best analogy that I always like giving at the end of the day. So what are the differences between Fidelity and IRA Club? Well, Fidelity is only going to let you use your IRAs, 401ks, 403bs to invest in the stock market, right? Stocks, bonds, mutual funds, ETFs, sometimes publicly traded REITs. Now, IRA Club has those options for you, but we also give you the flexibility to diversify your portfolio into alternatives, is what I believe in. And what IRA Club actually believes in, what we educate on, because that's one of our pillars, is the flexibility to diversify into different asset classes. Okay, established in 2008 by our fearless leader, Dennis Blitz. I sometimes refer to him as Master Yoda. This is the gentleman that wrote the text and the test for those that have a series 3, 6, 7, or 65. Again, he wrote the Kappa books and the actual tests in order to get your securities license. We've opened and funded over 15,000 accounts. We currently have 1.3 under administration, and we've helped literally one-on-one, 250,000 people, help navigate them through this process of self-directing, which I promise you, if you follow along, is very easy to do. But I always like starting off with 2 questions, okay? First question is, what is your number? If you were just to stop working today, do you have enough money to survive and last the rest of your life? Because according to CNBC, by the end of 2023, I know 2024 is still around the corner, the average American still spends $77,000, okay, up 5.9% from last year, which is a staggering number, which lets you know, although inflation is heading in the right direction, people are still spending. However, what is the average American spending in retirement? Okay, what does that number mean to you if you were to stop? So the average 65-year-old still is spending about $50,000, assuming you still had 19 years to live. And again, according to CNBC, you're going to need at least 1.1 million. I think that number is a little skewed because I really believe you need about 1.5 to 1.6, depending on your lifestyle. Okay.
And Ramez,
Yes, please.
really quickly, we have a request to put the QR code back up
No,
for just a moment.
No,
No.
no. Here you go. Please take a second. Go ahead, scan that QR code. And then if I fast forward a little bit, because the point that I was trying to make is these are the facts of life. Everything goes up, okay? If this chart was to resemble the historic U.S. inflation rate, which is 2.1 from 1929 to 2024, well, guess what? We are already at 2035 numbers. Think about that. That is a scary thought because most people do not have enough money to retire. The average 55-year-old has about 180. The average 65-year-old has about 210. The next question I want you to ask is, how safe is your retirement today? Think about this. Every single thing is working against your retirement. We know the stock market's been very volatile the last 4 to 5 years. We know that taxes will never be cheaper than where they're at right now. We know that pensions are no longer being offered. We know that every single government program from Social Security, Medicare, and Medicaid is a complete shambles. We also know inflation, although heading in the right direction, it's still affecting us. I don't care what anybody says. 77% of Americans are still living paycheck to paycheck. Okay. Keep that in mind, because what we preach and what we educate all of our clients is, what must you do if everything is working against your retirement account? You have to think alternatives. You have to diversify your retirement portfolio. In fact, this is what the average IRA Club client's portfolio looks like here, okay, for the last 10 years. So if you take a look at it, we heavily focus on real estate, syndications, private equity deals. The stock market's still here. Crypto has been a definite boom the last month. Okay. But the point I'm trying to make is we don't put all of our eggs in one basket. Okay. Why? I like to always think of retirement accounts because you can't touch them anyways until you're 60 years old, right? 59 and a half is when you legally could touch them without triggering a penalty. So the point I'm trying to make is if you're looking at these things, retirement accounts in particular, decade by decade, you have to think diversifications because at the end of the day, numbers will never lie to you. Okay. Numbers are always going to tell you the truth, no matter what anybody says to you. So what do I personally believe in? I always like real estate deals. I like brick and mortar. I like multifamily. I like anything that deals and within syndications that are backed by hard tangible assets. Because if you were to take a look for the past 20 years, okay, and if you're looking at again the blue, the forgive me, I can't see this because you guys are blocking me out, but the purple line represents the Shiller's Home Price Index. Okay, somebody who actually bought a house, your actual appreciation in the last 20 years has just been under 200%. Okay, for the past 20 years, just to show you the rate of appreciation is hovering just under 10% the last 20 years. The S&P 500 has given you about 321% returns on your money. But take a look at what real estate has given you. If you're investing in real estate, hard tangible assets, private equity deals, multifamily, syndications have given you just under 2,100% returns on your money. Don't you think it's just as important to diversify a portion of your retirement dollars, not only in the stock market, but alternatives? For that reason alone, so that's what we try to do here at the IRA Club. That is what we teach our IRA Club members. Think diversifications. My problem is, and Daniel knows this, we have a team of 5 that travel all over the country. Okay, I just mentioned I'm on the road 130, 140 days out of the year. And it's always the exact same 4 reasons why people do not self-direct. And it starts with lack of education. Okay. Think about this. This is nothing that we learned about in school, nothing that you learned from your college professor, economics 101, or anything of that nature. But you have to learn this strategy because it is a powerful tool to accelerate your wealth. And I'm going to talk about those numbers a little bit later. The one caveat that I absolutely love is when I do teach somebody this, they always tell me, I'm too old to get started. I'm 55, 60. When are you ever too old to tell Uncle Sam to kick rocks? Think about this. You're never too old to avoid paying taxes. And if this strategy helps you do it, do it. 2, identifying investment opportunities is the biggest challenge, in my opinion, to the IRA Club, because that is the one thing that I cannot do for you. I'm teaching you how to take the control away from the Fidelities, Vanguards, and the Schwabs, giving you, the investor, to do what you want with your money. But the problem is we at the IRA Club cannot choose the investment for the investor. This is the reasons why Daniel and your organization and your group and your club learn about alternative investments. Okay, my job is to facilitate retirement dollars to invest in these types of opportunities. Our disclaimer basically states, please reach out to your professional advisors, CPAs, lawyers. If you are using a fiduciary, which by the way, that's number 3, fiduciaries, brokers, and registered investment advisors are the reasons why, huge reasons why we see Americans not self-direct, because they, through artificial restrictions, will basically say, you can't do this. And I'm going to go into that a little bit later. Keep in mind, I said this to Daniel a while back. I come from a massively big family. I have 9 brothers and sisters. I'm so sorry. My dad's got 9 brothers and sisters. My mother has 9 brothers and sisters. I have so many first cousins in my family, over 130. And we, trust me when I say to you, we have our fair share of doctors, lawyers, and fiduciaries and registered investment advisors. And let me tell you something, they don't like me. They don't invite me to the Christmas parties and the holiday parties because I teach this strategy to take money away from their clients to alternative assets. Granted, I don't have a problem with registered investment advisors. There's over 1,000 registered investment advisors that utilize our strategy because they're listening to their clients say, get me out of the stock market. I would like to diversify a portion of my retirement dollars. So we don't have an issue or problem, but I want you to educate yourself on the true facts and stay away from artificial restrictions. And lastly, understanding Who's taking all of the risk within your retirement account? That's you. Always know that. And when you have an employer's plan, what you give up is the control aspect. But before I dive into it just a little bit further, I want you to understand the history of retirement accounts. 401ks, 403bs, 457s, all retirement accounts stem from the IRA, established in 1974. The reasons why it was established was to offset pensions. The Treasury Department knew back then less and less pensions were being offered. In fact, by 1974, 72% of pensions were offered back during that era. Today, it's less than 5%. What they didn't take into consideration is Social Security, Medicare, and Medicaid. Our government dished out over $2.2 trillion these last 2 years. These are not sustainable numbers. So something's got to give. And the Secured Act 2.0, which is a whole nother topic of discussion, Daniel, has really, really been addressing retirement. In fact, over 400 pages are, and actually 90 new provisions, which all of you should be aware of and know what they are. If you go to IRAClub.com, go to the Resource Center, look that up, understand what the new provisions are for 2024 leading into 2025. But all retirement accounts are self-directed. There's only 3 things that you cannot do within your retirement. You could not invest in collectibles. So that antique rug, that antique car, that expensive bottle of wine or bourbon, that's the only thing that you can't invest in outside of your own life insurance policy and an S corp. For obvious reasons, you can't double dip because you're getting the tax breaks. Now, Dennis Blitz refers to self-directing as a gift. I think it's one of the most underutilized ways that we can invest and have access to money, okay? In particular, retirement dollars, because IRA Club administers all these different types of retirement accounts, including covert L plans, okay? So remember, these are federal products, not state products that we administer. So a 529 plan is considered to be a state product. Keep in mind, because of the Secured Act 2.0, if anybody wants to talk to me about that, this is the first time ever a state plan and a federal plan will coincide. What does that mean exactly? So if you have a 529 plan for your child, starting next year, you could roll that over into a Roth IRA. Big deal. And you could use it for higher education. You could also self-direct it, do whatever you want with it. Now, that's another topic of discussion, but I want you to be aware of it because the true benefits behind self-directing is it gives you the flexibility and the control. And I keep saying this word control, and I don't mean to sound like a broken record because that's what it is. I'm going to talk about flat fees and why they're so crucial that you understand what flat fees are versus percentage-based models. And for me, the icing on the cake is telling this man, get out of my pocket, because 40% of what you make goes to this individual. And this is what we teach IRA Club members, and this is what they have figured out how to accelerate your growth 25 to 50% faster, because most people that we educate think it's only the federal tax rate that you're getting rid of. It's actually all taxes across the board. So you're talking about federal, state, Medicare, Social Security. I'm using the example of myself living in Illinois, Chicago. So think about this. I'm in the highest federal tax rate, not to mention right off the bat, you're eliminating 14.5%. You would obviously have to figure that out depending on what state you live in. Obviously, if you live in Florida or Texas or Alaska, you don't pay a state income tax. But some of you that are listening are in California, and you guys are in the highest state tax rate. So again, the national average is a little over 5%, but you have to take that into consideration that you have to play with those numbers, because when we teach individuals, so this is a case study of how you can accelerate 25 to 50% faster utilizing retirement dollars compared to using personal funds. So for those of you that don't know the difference between a traditional an IRA or a Roth IRA or traditional 401k or a Roth 401k, the difference is when are you going to pay the taxes. So in the traditional sense, you're doing a contribution and you're taking a deduction. You will pay the taxes later on in life. So when is that? After the age of 59 and a half, or 73 years old, which is referred to as the RMD, required minimum distribution. So for those of you that are over the age of 73 this year, remember December 31st, make sure you take out your RMDs. The Roth IRA, on the other hand, you pay the taxes upfront, okay? And all of the capital growth is tax-free for the rest of your life. Huge advocate of the Roth IRA. Why? Let me show you the difference between when using your personal versus deferred versus Roth. Let's just say within real estate or any alternative investment. Daniel, is it safe to say 12% within the alternative space is a realistic number? 12%?
Yeah.
In real estate? And I'm talking about 10 years. So for the next 10 years, average rate of return, annualized rate of return, 12%. Is that fair?
That's a number.
Okay.
That's fair.
Well, that's what I'm saying. I like to look at things decade by decade, knowing that you can't touch it anyways. So hypothetical, you move over $100,000 from, Fidelity, Vanguard, and Schwab. Look at what your personal dollars would be after 10 years versus traditional dollars versus Roth dollars. It's a substantially big difference because we preach also compound interest. The problem is Americans are not in the driver's seat. Daniel, how much money sits inside the stock market? Personal, retirement, collective. You know how much money sits inside the?
I don't know what the stock market cap is.
51 trillion. Do you know how much of that is retirement dollars?
I don't follow the stock market very closely, to be honest.
45 trillion of the 51 trillion sits inside retirement accounts. And the scary part is 97% of Americans hold their retirement funds in three places: bank CDs, annuities, and the stock market. That's it. The other 3% is self-directed. So I'm not going to get into too much of details between bank CDs and annuities. However, please tell me if you're listening, you could do better than 5%, because you got to think double-digit returns as much as you can. So with that being said, I know if you go Google this, I think Goldman and Sachs has got a CD right now for 5% 1 year. Annuities, I do want to focus on slightly before I get into the stock market, but in particular, fixed income annuities have been very heavily marketed to the last 3 years, because what do they promise you? They promise you don't have to worry about the volatility of the market, and we're going to give you a fixed income rate of return. And that on average is about 5%. But let's break down those numbers. Think about this. So if you currently had an employer's 401k, you're 55, 50, 60 years old, you're a little bit worried. Where's the market going to be 2 to 3 years from now, right? You're approaching retirement. So a lot of advisors, a lot of brokers are thinking, hey, you may want to do a fixed income annuity. Okay. Well, if I roll over 100,000 or 50 or $250,000, this would be my monthly payout, including Social Security for the year, for the month. My question to you is this enough for you to live off of? And according to the numbers that I stated earlier on the third slide, clearly it's not. So keep this in mind and I'm not saying it's a right thing or a wrong thing. I'm just talking out loud in strategies. These are my opinions because I believe that I could do better than 5%. The problem, me personally, with annuities is they are geared for salespeople in particular, because they are the biggest commission-based upfront fees, the most profitable. What most people and Americans do not know are they are not government-issued products. These are insurance products, which means your money is not FDIC insured. Keep that in mind. So if you are thinking about an annuity, make sure you're at one of the bigger firms. Please consider that. And also, go ahead, Daniel.
Oh yeah, I was going to say, when you have a moment here, we've got a couple of questions that I can fire your way. Let me know, and I know we didn't talk about this at the beginning, but I usually say we can take them as we go through the talk, or we can save them to the end. So you just let me know.
If it pertains towards a slide, I'm more than happy to stop. And I also feel like some of the questions might be answered as we go along.
Okay, we'll hold them off till the end a little more.
You got it. So just keep in mind that, again, what you're giving up is the control aspect, okay? Because otherwise there is a high surrender charges that are typically associated with these types of annuities. Make sure you're getting into the right one, but only 4% of retirement accounts sit within annuities and CDs. The other 93% sits within the big three, as I like to refer to them, okay? Fidelity, Vanguard, and Schwab. I'm almost willing to bet that 70% of you listening have a retirement account with one of these three. I'm one of them. I have a Vanguard account, okay? Because I like to do options trading, which I'll get into a little bit later. Fidelity is the first to capitalize on the employer's 401k. They control 33% of all retirement accounts. And here's the scary thought. They are actually not a publicly traded company. It's owned by one family. So you'll never know what they really make. Because according to Fidelity, now we're going to talk about numbers. Everyone's 401k, IRA, 403b by the end of 2021 was looking unbelievably great. You had $135,000, huge growth. By the end of 2022, well, guess what? It dropped 23%. Again, according to Fidelity. IRAs dropped 23%, 20% within IRAs, 19%, and 403bs. Same chart, exact same chart, source Fidelity. Take a look. By the end of 2023, it bounced back 14%, 118, 116, and 106. Why am I telling you this? What if I told you, and I think this is one of the most powerful slides that I have, there have been a total of 12 recessions in the last 50 years. Many of you probably remember the 2008 crash, okay? What I'm trying to get at is if you were thinking about retiring at the age of 60 and you are just there and you had $500,000 and you lost half, because that's what you lost, half. Well, guess what? You couldn't retire anymore at the age of 60. You had to work an extra 4.3 years of your life to get to that break-even point because you were not in control of your your 401ks. Fast forward to 2022, same concept. We know you lost 20% according to the slide. So here's year one, you lost, you're down 103. You are still down, although you're up 14%. So at bare minimum, you gave up 2 years of your time. Time is the most precious asset we have because the ugly truth are these accounts are designed to benefit them, not you. And they do this through artificial restrictions, control. And by the way, be very careful when you say, oh, my Fidelity advisor or Charles Schwab or one of the other 10,000 brokerage firms that you're dealing with. Well, you could self-direct with us. Why are you moving the funds over to the IRA Club? That's not true self-direction in our eyes. They're just telling you, here's a pool of investments that you could choose from. But if you say, for example, I found a house with, let's say, a house on 123 Green Street that I would like to use my IRA or 401k, they're going to tell you, sorry, you can't do that. And they do this through artificial restrictions because I really want you guys to understand the average balances within the stock market. In particular, when you look at 1929, right, when the stock market again came to fruition to 1979, take a look at what your rate of return was between this period, which was 404. Why am I doing this? Because everyone's retirement account had been depleted by this point on. But fast forward from 1980 to 1999. Whoa, what a significant jump in those 20 years. And that's because in 1978, that is when the 401k, 403b, 457s were introduced. This is when money was poured into the stock market. So if you ever heard your parents say growing up, go to school, get a job, get an employer's 401k, take the employer match, which you should, by the way, okay? Fast forward 2000 to 2023, that rate of return has dropped from 5.65. This is not even taking into consideration inflation during this period, because obviously inflation works against you. What I'm trying to get at is the old way doesn't work anymore. You got to be thinking alternatives because, again, numbers do not lie to you. If there are 65 million IRA accounts across the country, of which only 2 million accounts have $1 million or more, what are the 63 million accounts doing wrong that the 2 million are doing right? The answer is very simple. They're just in control of their retirement accounts. I'm just going to burn through this real quickly, Daniel, just to get to the questions. Most Americans, 62% of them, have no idea where to find the fees, in particular, hidden fees within their 401k statements. The national average, a number you could go Google, is 2.57% within employer accounts. I really want you guys to take out your phones and take a picture of this and find out from your HR departments what are these fees and how are they incorporated. And many of them are going to tell you they're very minute, very small. They're like, 10 basis points or whatever the case may be. I refer to these fees as termites, just nitpicking at your retirement account. All right. So the point I'm trying to make is when you tack up these fees, they are traditionally between 1% to 3%, especially if they're managed, okay, by a fiduciary. All right. And the majority of your employer 401ks, in fact, 83% of them sit within mutual funds. For those of you that don't know what mutual funds are, large, mid, small, international stocks, bonds, and that's their definition of diversification. Okay. But have the highest fee-based structures. Why am I telling you this? Because IRA Club does not believe in percentage-based models. We believe in flat fees. What we charge every single one of our members is a flat $195. And by the way, I don't care if you have 10,000, 100,000, a million, or 10 million. What's the most that IRA Club could take from you? $195. So wait a second, you're going to be like, how does IRA Club make any money at $195? It's per investment. So if you find a house on 123 Green Street, it's $195. If you do an oil and gas deal, it's $195. If you do a private equity deal, $195. You do a syndication, it's $195. We believe in diversification at the end of the day. I really want you to focus on this because I want to drive this home. So if you had $100,000 at Fidelity, like I said, decade by decade, every 10 years, you have a 10% rate of return, standard S&P 500, right? Look at what IRA Club fees, $195 versus the standard 1% to 3%. IRA Club in 10 years will save you $78,000. But imagine if you had it with the IRA Club for 15 years or 20 years or 25 years. This is not my money. This is your money they're taking from you. And understanding that the only time that you get paid is when the market is up. If the market is flat or down, are they still taking their cut? Of course they are. So what does the IRA Club truly offer our clients? It's basically, we're going to walk you through the process. We're not a call center. That's another hiccup that we have. Nobody understands the process, okay? So we're going to handhold you. You're not sure what to do. You're assigned an IRA Club specialist that will walk you every step of the way. Your money, don't forget, is FDIC insured. We already talked about flat fees, fully streamlined e-signature process. We do all the filings, the 1099R forms, 5500 forms, RMDs, distributions, up-to-date resource centers. We're always constantly, writing our blogs, doing emails, podcasts, webinars. Investors Row is a place to discover investment opportunities. But don't forget, we do not have a problem with the stock market. In fact, we have a trading platform, and Daniel actually is going to be doing a webinar with an individual called Randy Tate, hopefully shortly, that talks about AI. In fact, we are the first self-directed IRA company to partner with a company called iFlip, established back in 2017. This was the perfect partnership. Why? The AI, what it's designed to do, and I'll get into it in a split second, is help protect your retirement account from the losses, okay? Think about it. The American mindset has always been set it and forget it within your retirement account. Why not have a platform that protects your retirement account? Because I just talked about all of the losses that you've had, right? All of the market corrections at one point, where our AI technology with iFlip has helped save our clients 24% within their retirement account because the AI is literally outperforming you. And now I'm not going to get into the nitty-gritties of this, but I'm going to actually, if you want, quick video.
A trusted leader in self-directed retirement accounts
that explains it.
has partnered with iFlip to give you access to its cutting-edge investment platform. iFlip's Smart Folios are investment products that use AI to actively manage your investments, assess risk, and predict outcomes. And you can also trade individual stocks with ease. IRA Club empowers you to make informed decisions about your retirement savings with advanced technology, low, flat fees, and a commitment to IRS compliance. Why is that important? Let's take a closer look at how iFlip works. No one knows where the market's going next. So how can long-term stock and ETF investors like you stay protected? What if you could use artificial intelligence to minimize your losses, maximize your profit, and automate your investing? Enter iFlip, an automated investment platform designed to minimize your portfolio risk. By limiting your exposure to the market's worst days, iFlip may help you save an average of 24% during market crashes and generate even better returns when the market recovers. iFlip's proprietary smart folios are baskets of stocks and ETFs protected by artificial intelligence. When iFlip gets a signal to buy or sell an investment, it does so automatically without you having to lift a finger. You can change your strategy or withdraw at any time. And with transparent subscription-based pricing, you'll never be caught off guard. No hidden fees, no strings attached. With iFlip, there's never been a better time to take a second look at your portfolio.
So if you guys are ever interested or just want to learn more about the AI platform that we offer, fully integrated, so every IRA Club client gets a trading platform that has access to this AI with iFlip, feel free to scan this QR code to learn more about it. You could schedule a demo. And as I mentioned earlier, Daniel's going to plan to have Randy Tate, the CEO, and Kelly Korshak, who's the individual who created the AI platform. Okay. I'm not going to get into great detail about that because he's going to talk about that during his own time. But one of the things that I do want to mention is we do not charge for our trading platform. We waive the $195 asset fee. IRA Club does not make a single dollar if you use our trading platform. iFlip, on the other hand, does charge $7 for a subscription per month, which is nothing compared to what I just showed you on percentage-based models. Just keep that in mind, okay? What does the process look like? Real simple. Open, fund, invest. That's it. It takes 8 to 10 minutes to open up an account. You need a government-issued ID. You need to name a beneficiary, and you need to know your social security number, okay? And it would be very beneficial to have your most recent statement at your current custodian. Only 3 ways you could fund a retirement account: making a contribution, an IRA to IRA transfer, or if you have an old employer's 401k, we can roll that over for you. We do have something called an ACAT system where we can physically go and move funds and securities over to the IRA Club. And lastly, the only thing I can't do for you, choose your investment. The one thing I can't do, but I promise you, if you could identify the investment opportunity, do not worry about steps 1 and 2. Very easy. Opening and funding can be done within days, okay? If you'd like to learn more, if you would like to get started, Daniel, this is the landing page that we kind of created for the club, for the Alternative Investment Club. And if you don't mind, maybe we could just throw it inside of the chat. So if you want to schedule a call, I highly recommend that should be step number 1. Many of you that are listening is probably just not sure what type of retirement account. We see this all the time. I talk a lot about Roths and Roth conversions and mega backdoor Roths. So a lot of people just open up a Roth IRA when they have a traditional 401k. Well, that's going to get rejected. So it would be good to sit down and talk to Mandy. And many of you that maybe have an HSA, which is one of the most powerful ways to invest, that can be done through alternatives. So you can diversify that. So if you have an employer's HSA, most people don't know this, Daniel, you don't have to wait to leave your employer. You could move an HSA tomorrow if you want over to the IRA Club to diversify that into different asset classes.
That actually relates to the first question that we have here.
Oh,
did
awesome.
you?
Let's do it.
So for everybody that's here, we have quite a few questions in the chat. I'm going to take them in the order in which people put thumbs up icons on them. Good. So we've got 2 that have thumbs up icons, Sherwin's and Ashish's currently. If you see a question that you really like, put a thumbs up icon on it, and I will do my best to make sure they're asked in that order. All right. So Sherwin's asking, can a current employee get out of our current employer's account and do a self-directed account? So you kind of answered that, but maybe you could elaborate.
Listen, okay, the answer is no, because remember, the system is designed to benefit them. They're in control. You're not in control. That's when you give it up. So for those of you that have, and be very careful, okay? Starting next year, it's going to become mandatory that more and more states must offer a retirement account for each one of their employees, okay? If they're part-time employees, it's 2 years. If they are not, and I repeat, not offering an employer match, don't take it. If they are offering an employer match, take it. But the question still remains, can I move the funds over? The answer is no. There's only 2 things that you could do. One, if you're over the age of 59 and a half, you can legally pull out the contributions and roll those over to the IRA Club. However, you could not pull out the capital gains until you leave your employer. The other thing that I've seen individuals do is, I don't know how close you are with your employer or your boss, but I've seen people literally quit their job for 30 days, move over $300,000, $400,000, $500,000, $600,000 to the IRA Club. Now, I'm not suggesting that. Don't do that, but I've seen people do that. That's your only other option.
Okay. And there was actually a very similar question that's got a thumbs up on it about what about moving funds over from a 401k? Does that still apply in that case?
Oh, it has to be an old employer 401k, not a current.
Gotcha. All right. So let's see what's next here in terms. Hey, as far as a topic, AI trading for stocks, I'm interested in people's reaction to that as a topic. So can you put either a yes or a no in the chat to tell me if you're interested or if you're not interested in that topic?
Oh,
Let's see. And then Ashish's question here. He names Solera is a combined bank and SDIRA custodian that has low fees. And what does the IRA Club offer that a low fee option doesn't?
so great. So Solaris Bank. So let me take a step back. I will never, ever, ever badmouth my industry. I love my industry because at the end of the day, we're all educators. It really comes down to fee structures, tech, what they offer, and customer service. Okay. So with Solaris, they only offer checkbook IRAs. That's all they offer. Okay. Why is that so important to understand? IRA Club does checkbook IRAs also. You could open up a bank account with our bank, Meridian. So same concept like Solaris. But I want you to understand, so it's established the LLC is $995 for the year. The IRA, as I mentioned, is $300. Think about this. I open up the LLC, I open up the IRA, I move the funds from Fidelity, Vanguard, and Schwab over to the IRA Club. I move it from your IRA over to your LLC. I give it to you, and I never speak to you again. And I never talk to you again. My question to you is Solaris is not an administrator. They only do checkbook IRA LLCs. How many people do you think screw those up within the first let's say 5 years? I will tell you that number is about 73% because we see that here at the IRA Club. So understand, I make more money off of you up front, day one. I'm still charging you the $200 and I never speak to you again. But my job is to protect you being our IRA Club client. So I hope that makes sense. And I don't care. And Daniel, just to be clear, don't ever think it's about $195. I really don't care about $195. At the end of the day, just think of it like, is it worth it to do a prohibited transaction? And by accident, it could be by accident. Is it worth all the money you're about to pay in taxes to save a couple $100? It doesn't make any sense, is what I'm saying at the end of the day.
All right.
And Daniel, the best one that I always get, well, how's the IRS ever going to know? And the analogy that I always like giving is, how many times have me and you rolled a stop sign or blew a red light in our life? I've done it quite a few times, but just because the officer isn't in the corner to catch you, does that make it right? But if you get caught, it's a pretty hefty ticket.
It is. All right. Glenn is asking about, you mentioned a lot about growth strategies. Do you work with groups or stocks or that do distribution-based strategies or income-based strategies?
We personally deal with over 1,000 different types of sponsors, partners, registered. I mean, it's all over the place. And the answer to your question is yes. But if you would like to schedule a call with me personally to talk about that, feel free to click on that button and you could schedule a call. More than happy to.
All right. Going down to AB is asking, what are the fees for exiting an investment? Is there a fee for selling?
Here's our pricing. It's right there. Roll it up. It's $150, I believe. $150.
Okay.
Oh, I'm sorry. $200. I was off $50. There you go.
All right. Let's see. I'm looking for any more that have thumbs up. If I don't see any more, I will start going through all the other questions here. Let's see. All right. I converted my 401k to a solo after I left my job. This is from Paulette. I wonder if there are any tips on maintaining solo 401k compliance if you are not really making income consulting.
So good for you with the solo 401k. I think the solo 401k is much more powerful than the IRA. Just keep that in mind. But most Americans, less than 9% of Americans qualify for a solo 401k. So for those of you that are listening that want to open up a solo 401k, you have to be self-employed or the sole proprietor of an LLC, C Corp, or S Corp. Okay. That's the only way you qualify. So the answer to your question is, it's so for us to administer the account, I hope this answers the question. I'm not sure if I'm answering it, which is $395. So a 401k, the only disadvantage is it's a lot more expensive to maintain it because it's got 200 pages worth of rules and regulations versus an IRA has only got 9 pages worth of rules and regulations to follow. Okay. So what I'm trying to get at is it is more powerful because of the contribution limits. You don't have to worry about UBIT or UDFI, and you could borrow against it up to 50,000 at prime. But other than that, it's basically the same. Everything else is the same. Constitutes is the same as far as investing.
All right. Next is Manju. How iFlip can help if the investment can iFlip help if the investment is a syndication?
Of course. Okay, so let's use me as the example. And Daniel, I think I told you this one time. I have parking spots in my Roth IRA because I live across the street from Millennium Park. For those of you that don't know where Millennium Park is, just think of Central Park to New York. We don't have parking. So I use my Roth IRA to buy parking spots, okay? Then I have 2 private equity deals. I have 2 syndications. I do have a house in Northwest Indiana. So all of these things, asset classes, are giving me rental income, royalties, or dividends. When that money comes back to the IRA club, not just me, but a lot of our clients are saying, well, what can I do with this extra 5,000, 10,000, or 50,000? What do you think they were doing with it? They were just shifting it right back over to Fidelity, Vanguard, and Schwab. So we were losing millions of dollars every single month back to Fidelity and Vanguard and Schwab because we never had a solution for stock trading. So what we offered every single one of our clients is a trading platform that is fully integrated to their IRA Club accounts. This is what I just showed you. Once you click here, you're going to put your username, which is your email, your password, log in, and it takes you straight to your Roth IRA Club account. You literally could move cash from IRA Club to iFlip to do stock trading or choose one of the AI Smartfolios. Once it grows, you could move the cash from iFlip, which is the broker dealer, over to the IRA Club to do alternatives. Literally, you could just choose whatever Smartfolio you want, depending on your risk tolerance, because I can't do that for you. Or you could get into certain sectors like energy, tech, oil, S&P 500, Bitcoin, or just the money market account. So don't let your money sit at the IRA Club. I'm trying to teach you how to grow it and accelerate it so you could get into the next alternative. That is what I do with my Roth IRA and so many other clients here at the IRA Club. Hope that made sense.
All right. Alex is asking, can you do crypto in your self-directed account?
Of course you can, 100%. I have a crypto account with Gemini.
Ashish is asking, does the IRA Club do due diligence on the investments that are on your platform?
No, what we will never do due diligence. We can't do due diligence because it defeats the purpose of what a self-directed IRA is all about. We expect you to do the due diligence on the companies, on the investment opportunities. Okay. And if you ever want resources, we're more than happy to help you with the resource side of it. Who we contact, who we reach out to, like every single person, step number 1 should be looking at the EGDR SEC website. Make sure that it's filed with the SEC. Look at to make sure how it's structured. Okay. I would also, if it's a fairly decent amount of money, 50,000, 100,000 within your retirement account, we use such company like Thomas Reuters. I'll pay the $500 to do a thorough background check on the company or the principal partners. I have a whole list of questions that if anybody wants them, feel free to email me. And Daniel, I'm pretty sure you've had those types of conversations that you could email that to any one of the club members.
Yeah, you're not a registered investment advisor, right? So you'd be running into SEC problems giving advice out.
Nope, cannot.
Okay. Okay. Um, there's a question, was the 195 a per year fee?
Yes, it is. So it's a yearly fee.
Okay. And is it per year per property or just per year?
So so 195 for us to administer. Here we go. 195 for us to administer, and then per holding, which means per investment or per house, will be 195. Okay. So if you have, let's just simple math. If you have 3 houses or 2 houses, so it's 195 plus 195 per house. So you're talking about just under $600.
And okay. Oh boy, we've got a lot of questions here. Help me out, people, by putting thumbs up next to the ones you want to hear, because we're not going to get to all of them. Raju is saying, I went to the IRA Club and it asked me to take a survey so that I can suggest investment options. I selected. Okay, go ahead.
This is it right here. So we have a platform called Investors Row. What is Investors Row? A place to discover investment opportunities. These are some companies that we've worked with for years, okay? Bare minimum, at least 1 year. So again, we still can't choose the investment for the investor, but what's nice about this is it's fully integrated into our banking software. I still cannot choose it for you. What you're clicking on is let us help guide you, which means what are you interested in? Are you like, I'm interested in investing, and then what it'll do is it'll filter down what you want to do, build wealth. It's just a platform to help you.
There was a question here about a little confusion over once you leave your employer, can you roll your accounts over?
Yes.
Or do you have to fund them?
Yes.
You can.
So if you have, if you have a current 401k, I'm sorry, you're locked into it. Okay. Unless you're over the age of 59 and a half, you could roll over what you've contributed. That's the only time you could do that. Okay. If you have an old employer plan, like an old 401k, 403b, or 457, yes, you can roll that over to the IRA Club.
All right. Prolette is asking, do you have a good example of UDFI calculator?
Ah, awesome. Good for you. So guides, if you go to guides, anytime now, and you scroll down, how to calculate UBIT. We have these great guides on our website. This was written by our president, Dennis Blitz. It gives you great analogies and examples of when you trigger UBIT, how it happens, okay? And the most important thing to look out for is this chart right over here. For those of you that do not understand what UBIT is, it's a whole nother topic of discussion, okay? And it could take 30 minutes to break that all down. But number one, UBIT is triggered, in particular UDFI, unrelated debt financed income, is triggered when you leverage, okay? And if you do leverage, let's just use simple math. Let's say this property is $100,000. You only have $50,000 inside of your IRA, and you want to leverage the other $50,000 in order to buy the property. Well, number one, 99.9% of banks across the country do not like to leverage against you a retirement account. That's one. Two, it has to be structured as a non-recourse loan. But if you do leverage, now you are triggering UDFI, okay? So let's just use, again, simple math, 1% rule. You're getting $1,000 back to your IRA account, of which 50% of it is now subject to UBIT. Let's just say, hypothetical, you pay the interest, the principal, the property taxes, and you're making $250, hypothetical scenario, okay, per month. That is what now is subject. If you take 250 times 12, just under the 2750 marker, you are now subject. I'm sorry, that's just over $3,000. Forgive me. I know math. $3,000, you're going to fall in between the second category, which means you are going to pay $275 plus 24% on the $3,000. So my question to you is UBIT worth it? I shrug my shoulder and I kind of look at people and I say, no, it isn't. The only way you could avoid UBIT, 3 ways. The solo 401k, okay? Partnering You can partner your retirement accounts. So let's say me and my spouse, I have 50,000 in my IRA and my wife has 50,000 in her IRA. We can partner together to buy the assets outright or jump in a syndication or private equity deal or whatever it is that you want to do. My daughter, who's 2 years old, sorry, she's 3 years old, has 2 parking spots with me. I partnered my daughter on 2 of my parking spots in her Roth IRA.
All right. And AB is asking, what's the process for rolling an HSA?
Great question.
Go ahead.
Same exact concept. So an HSA is the same set of rules and regulations when it comes to investing. Again, my recommendation would be schedule a call with Mandy Drysdale. Okay. She has a team. She has a team of 5 people that will walk you through this process to ensure that you're opening up the right type of retirement account. Okay. Again, same concept. So if you go to open up an account, or if you go to your landing page, here's your landing page. You go to open up an account and you are going to click HSA right there. No, it's not inherited. Very easy to do. And they just go through the process.
All right. Ramz, thank you for coming in and speaking to us. Could we have everybody take themselves off mute and thank Ramz for coming in and talking to us?
Thank you, guys.
Thank you.
Thank you.
Thank you.
I hope this was educational.
Thank
you.
Thank you.
Thank you.
Thanks, Ramz.
Thank you, guys, for having me.
Thank you, Daniel.
All right. And next week, following our end, not next week. Next week, we will not be here after Thanksgiving. The week after that, we have a specialist in estate planning coming in locally from right here in Hillsboro, Oregon. So look forward to that. It's part of our end of the year education for people who need to make changes and get advice.
Happy Turkey Day, everybody.
Happy Turkey Day.
Thank you, everybody, for having me.